I want to start. I feel like the U.S. consumer and the Chinese consumer are two completely different stories. So I want to start with the U.S. in terms of the greater weakness. Is it across the board, or is it this bifurcation that we just keep seeing? Higher end still spending, going nuts. Lower end really crimped.
Well, there is certainly a bifurcation across consumers. The lower end consumer is feeling the pressure of economic headwinds. In fact, while we don't operate in the economy tier, in the economy tier, they actually had negative revenue per available growth in the second quarter. But as you move up the chain scales, we are seeing continued strong RevPAR growth, really across segments and across geographies. In fact, the strongest growth we saw in Q2 was in the luxury segment. And so that luxury customer continues to spend, continues to have confidence, and continues to prioritize spending on travel and experiences versus hard goods.
Can you give a sense of, in the non-luxury segment, where consumers are pushing back, what they're not willing to spend on in the same way that they were, say, a year ago?
Yeah, so it's really interesting. If you look at our Q2 numbers, with the exception of Greater China, which I know we'll talk about, we saw strong growth across every geography and across all three segments we operate in: business transient, group, and leisure. So it's not that we're seeing really a pullback in travel. We are seeing a little bit of a level of caution in some of the related discretionary spend. So when you look across most of the markets we operate, food and beverage spending, for instance, was down a bit. So those consumers, it appears, are still prioritizing travel, but maybe they're being a little more judicious on their spending as they travel.
Well, Tony, you've been with Marriott for a few cycles, joining in 1995. I wonder, when you look at the consumer now and some of that concern, that pickiness of what you're seeing, how similar or how far away does it look from past downturns?
I think, well, from a macro perspective, not terribly dissimilar, other than the trend I just mentioned to Lisa, which is we have great credit card partners in American Express and JP Morgan Chase. And so we have really rich consumer spending data to evaluate. And pre-pandemic, you saw some of the younger demographics starting that shift away from purchase of hard goods towards experiences. Post-pandemic, it really appears to be across demographics. And that's a trend that seems to have the legs to endure long beyond the end of the pandemic. So I think that's a distinction. For Marriott, we're a different company than we were in different cycles. A higher percentage of our business is franchise versus managed, so you don't have that incentive management fee volatility. Higher percentage of our revenue comes from non-RevPAR related sources, like our branded residential business, like our branded credit card business. We're much more international than we were in previous cycles, but there are certainly some similarities.
And you have yachts now?
Now we have yachts. In fact, Ilma, our second yacht, launches next month.
Well, I'm just curious about this idea of investing in luxury. How much of this do you say, this is just of the moment, this split we're seeing, or we want to buy more boats? We want to have Marriott private jets in the sky. What does it mean to either just continue on the trend or double down on it?
Well, the good news is we're not buying any of it. You know, we're an asset-light model, so we have terrific partners who are investing meaningfully in luxury. And we want to lengthen the lead that we enjoy in luxury. We've got the industry's largest luxury footprint. We have the industry's largest luxury pipeline. We have the industry's largest luxury branded residential business. And yacht is just a natural extension of that. We find that luxury customer wants to spend a higher and higher percentage of their travel wallet with the brands that they really trust. And when we look, again, it's more anecdotal because we've only been in the water for 2 years, but more than 50% of the passengers have never cruised before. And so I think they look at that Ritz-Carlton brand as a little bit of a housekeeping seal of approval. And more than 75% of the passengers we've had are Bonvoy members. And so that 210 million member loyalty platform really gives us a channel to talk to them about our expanded offerings.
Before I move on to international, because I want to ask you about the Chinese consumer, I want to ask you about Hawaii. And I know you have a lot of concern. You put a lot of effort into rebuilding what was going on in Maui after the wildfires. Is tourism coming back?
It is. We just passed the 1-year anniversary of those horrific fires in Lahaina. I had my whole leadership team in Maui just last month. The great news is the Army Corps of Engineers is to be applauded. The progress they've made in cleaning up Lahaina, preparing Lahaina for redevelopment is really encouraging. We had the commander who's running the effort give us a tour of Lahaina. There's a house under construction, which was really important symbolically. But the aloha spirit of Hawaii is as strong as it's ever been. Our people are passionate, they're resilient, they're excited to see tourists coming back, but they're still operating at occupancies in the 60% range. And so if your viewers hear nothing else, go to Hawaii. They need the business. It's as attractive as a destination as it's ever been.
So who is traveling right now? We spoke to the Four Seasons CEO yesterday who said the Americans are out there and they're traveling. They're seeing weakness with the Chinese consumer. Is that similarly what you're seeing?
Yeah, although interestingly, the high-end Chinese consumer is traveling a great deal, but they're not traveling in China. So when we reported our second quarter earnings, the highest submarket we had in terms of year-over-year RevPAR was Japan. RevPAR in Japan was up 21%, and a lot of that was driven certainly by American travelers, but by high-end Chinese travelers.
But also, how much is that driven by the weakness we've seen in the yen? And travelers want to take advantage of that.
That's the case. But I think that outbound Chinese traveler was locked down in a really significant way. And you've seen the Chinese government create visa-free travel across the APEC region. And so we're seeing strong outbound Chinese travel in Japan, Thailand, those sorts of destinations.
As an American company based in America, does it give you pause to keep the footprint in the size that you'd have in China, given some of the overlay of tensions between the two countries, as well as the lack of appetite to go beyond that APEC region by Chinese wealthy travelers?
Well, I have an expectation eventually they will come back. If you think about pre-pandemic, the growing middle class in China and their appetite to explore the world was one of the things that drove a lot of optimism across our sector, and I think that will come back eventually. To your first question, we've got a little more than 500 hotels in China today, nearly the same number in our pipeline, and almost the entirety of that portfolio is owned by Chinese companies. And so I'm not sure we're necessarily viewed as an American company in China because the assets are owned by the Chinese, and they love global brands like Marriott. And so, of course, our business thrives in times of political stability. And when you have ratcheting up tension between the U.S. and China, that's not great for travel. But our demand levels in China are back to pre-pandemic levels. The reason we reported such weakness in RevPAR is because of rate. And rate is soft, one, because a lot of the high-end Chinese consumers are leaving China to travel across the region. And the booking window, because of weak consumer confidence in China, believe it or not, is under 3 days. And so they're making those decisions very close to travel for in-country travel.
So just to tie this all together, I know that Marriott had a subdued kind of outlook going forward in terms of how quickly you can see some sort of normalization or at least reversal of what we've seen, particularly in the lower end consumer. How deep do you think some of the weakness goes, the reluctance? I mean, is this just a matter of economic uncertainty, or is this something that you're seeing escalate in a more significant way?
Well, I think your term normalization is the right one. Remember, we saw our business drop by more than 90% in the early days of the pandemic. So for the last couple of years, you've seen demand come roaring back. The benefit of those really favorable year-over-year comparisons has faded, and we're settling into a more normalized demand environment. Weakness in the consumer obviously hits our business. We operate in a cyclical industry, but I think everybody's waiting for September, and if the rate cuts that are expected materialize, that'll be a boost for the consumer. Obviously, I'm going to be watching you at 8:30 to see what the inflation numbers look like, but all of that factors into that mindset of the consumer. But the thing that gives me confidence beyond the next quarter or two is this almost sociological shift we've seen with this appetite for travel. And I think that bodes really well for our business.